March 12, 2025 was a day to forget for Indian investors. The Bombay Stock Exchange resembled a Mumbai monsoon, with indices drowning in a sea of red. Both the Nifty 50 and the Sensex, India's benchmark indices, took a hit. The Nifty 50 dipped 0.12%, settling at 22,470.5. Meanwhile, the Sensex mirrored the sentiment, shedding 0.1% to close at 74,029.76. These numbers, while seemingly small, reflect a broader anxiety gripping the markets. The bloodbath wasn't indiscriminate, though. One sector in particular felt the brunt of the selling pressure: information technology. The Indian IT index plummeted nearly 3%, officially entering bear market territory. This means a drop of over 20% from its peak on December 13, 2024. What's spooking investors? Jitters about the US economy and its ripple effects on the tech sector, a crucial revenue stream for Indian IT giants. This decline wasn't just a blip on the radar. It marked a culmination of weeks of uncertainty and negative news flow. Investors, already on edge, reacted swiftly, pulling out their money and sending shockwaves through Dalal Street. The Indian IT sector, once a darling of foreign investors, is facing strong headwinds. The US economy, a major market for Indian IT services, is flashing warning signs. Fears of a recession are mounting, with whispers of decreased IT spending sending shivers down the spines of investors. Adding fuel to the fire is President Donald Trump's recent decision to slap tariffs on Canadian steel and aluminum. This protectionist move has further stoked fears of a global trade war, impacting global economic sentiment. The uncertainty surrounding the US economy directly impacts Indian IT companies. These companies rely heavily on outsourcing contracts from US corporations. If the US economy slows down, these contracts could dry up, hitting Indian IT firms hard. This uncertainty has led to several high-profile downgrades of Indian IT giants. Morgan Stanley downgraded Infosys to equal weight, signaling reduced confidence in the company's future prospects. Motilal Oswal went even further, cutting Infosys to neutral and slashing Wipro to a sell rating. Despite the gloomy picture painted by the IT sector, it's not all doom and gloom for the Indian markets. One bright spot was the performance of the financial sector. HDFC Bank and Kotak Mahindra Bank defied the trend, posting gains of 1.5% and 2.5% respectively. This divergence in sector performance suggests that the concerns are largely centered around the IT sector's specific vulnerabilities to the US economy. Other sectors, like finance, seem to be holding their own, indicating that the overall Indian economy remains resilient. Furthermore, there's a glimmer of hope on the inflation front. India's consumer price inflation cooled to 3.61% in February 2025. This is significantly lower than the 3.98% forecast by Reuters. This easing of inflationary pressure, driven by moderating food prices, could provide some relief to the markets. While the recent market dip has undoubtedly rattled investors, many analysts are urging caution rather than panic. The Indian market, they argue, is relatively better positioned than many global counterparts. Recent market corrections have brought valuations to more reasonable levels, making Indian stocks more attractive to long-term investors. There's also a sense that much of the negative news, particularly regarding the US economy, might already be priced into the market. A cautious optimism prevails, with experts suggesting that the market correction might be nearing its end. However, unforeseen risks, such as escalating trade tensions or a sharper-than-expected US slowdown, could still derail the recovery. Indian investors should stay vigilant, focusing on fundamentals and avoiding impulsive decisions based on short-term market fluctuations.